Hey guys, it's Kieran. In this lesson, I'm going to talk specifically about risk management, and there are certain updates that I've made to my previous videos. And of course, I'm constantly doing research and constantly doing statistics and really trying to really improve the data and really try to keep you up to date really with it. So going back to this diagram, this is very much based on my experiences, but I'm sure many traders can relate to this. And so I've actually put strategy and developed and backtested algorithm as relatively, whilst it's important, not as important as other things, for example, risk management. For example, if you had a very good strategy, but if you, for example, risked half your account on a trade, it doesn't matter if your win rate is 80%, you're not going to have enough attempts for you to actually be able to prove that your strategy has enough of an edge, because after 2 losses, then you'll just be out of the game. And so risk management and specifically trading psychology is such an important aspect of trading. And of course, other things will, like enough market exposure and knowing when not to trade. So I'm going to ask you guys a quick question, okay? Who's really taking more risk? Bob risks a total of $50 per trade with 2x leverage out of his $500 account. Or B, Sam, who risks a total of $1,000 per trade after 10x leverage out of his 100k account. So I'm going to give you guys some time to think about it, and I'm going to come back to the answer to this question at the end of the stream, okay? But it's just food for thought. And so there is method to the madness, why I always say risk 1% of your account per trade, because it means that you have 100 attempts before you actually blow up your account. And of course people risk different things, but specifically when you're starting, and it's just a very good rule of thumb, because it really ensures that you have enough edge and enough really attempts for your edge to really catch up, and it really reduces pressure on you for one trade. And of course, you just divide 100 by the percentage you're risking, right, to find how many attempts you have. So for example, if you divide 100 by 1.5%, if you risk 1.5% of your account in a trade, then you have 6.7 attempts for you to blow up your account. And vice versa, if you risk 2% of your account per trade, then if you divide 100 by 2%, that means you have 50 attempts before you actually blow up your account. And naturally, if you risk 50% of your account on trades, that means that you only have 2 attempts before you actually blow up your account. And so you just have to play around with these numbers. And usually most of the time I risk 1% of my account per trade. If I'm less confident in the trade, but if it's a valid trade, then maybe 0.5%. But I usually ensure that I don't have more than 1.5% exposure at all times across all positions. So this is just some rule of thumbs that I use. Of course, there's different ways to skin the cat. But now going back to this example, okay? So Bob risks 1% of a 1k account of his 100k account on Bitcoin. So say he wins 3%. So in other words, he grows his account by $3,000. His new amount now is 103k. And so 1% of that will be $1,030. And so whilst he's still risking 1%, and so the proportion he's actually risking is still the same, the actual nominal value has now increased. And this greatly contributes to the exponential nature of trading, in that once you're consistently profitable, your results will be exponential. Conversely, if Bob loses 1%, so he has 99k, and so now 1% of that will be $990. So whilst proportionally he's still risking 1% the same as before, his actual nominal value has now reduced. And so you have to really greatly adjust the amount you're risking with further wins or losses. But the actual amount in terms of percentage, you're still risking the same amount of your account. So intuitively, it does make sense when you play around with it. And so say, for example, Bob has a 100k account. He has a very good month and he grows his account by 10% using very good risk management. He now has 110k. But now, 1% of that is now 1.1k, or $1,100. And so as you can see, as you make more, you can actually also have exponential losses and exponential gains as well. Say he wins a trade and it's a 3-to-1 risk-reward ratio trade. Then that means that if he wins a trade, he'll make 3.3k. And so this will be 3 times the amount he risks. And so it's just to appreciate how the actual nominal value changes dynamically with time. And I always talk about this as well before. It doesn't matter which risk-reward ratio you use, and you cannot take that in isolation. You have to also compare that with win rate as well, right? For example, if your risk-reward ratio is 1 to 3, then that means that if you win 1 out of 4 trades, you will break even. And so you need a 25% win rate to break even. And vice versa, if you have a 1 to 2 risk reward ratio trade, so in other words, you make 2 times the amount as the amount you lose when you lose a trade, that means you need a 33% win rate to break even. Because naturally, if you win 1 out of 3 trades, then you will break even. Similarly, if you have a 1-to-1 risk-reward ratio trade, then that means that for you to actually break even, you need to win 5 out of 10 trades, or in other words, 50%. And so you just have to play around with these numbers, and intuitively it does make sense the more you practice and play around with this table. And so going back to the last picture, so if you have a 1-to-3 risk-reward ratio trade, then you need 25% win rate. So you need to have at least winning 1 out of 4 trades to break even. And so in other words, if you win more than 25% of the trades, so in other words, if you win more than 1 out of 4 trades, then you're going to be a profitable trader, because you only need this much to break even. And so as you can appreciate, if you, for example, have a 30 to 40% win rate and across 10,000, 100,000 trades across your lifetime, naturally you're going to be very, very profitable. And so you just have to play around with these numbers. And similarly, as mentioned before, if you have 1-to-2 risk-reward ratio trade, then you need to have a 33% win rate to break even. And naturally, if you win more than 1 out of 3 trades, or in other words, if your win rate is more than 33%, then naturally you will be a very profitable trader. And so you just have to play around with these numbers again. And so if it's a 1-to-1 risk-reward ratio trade, then you just need to win 50%, or 1 out of 2 trades to break even. So naturally, if you place 10 trades, and if you win, on average, if you won 5 and lost 5, then if you decide that, okay, if you win 6 out of 10, and if your risk-reward ratio is a 1-to-1, so you're winning the same amount as you're risking, then if you win more than 50%, or in other words, more than 5 out of 10 trades, you're going to be highly profitable. Just vice versa, really. Play around with it. So this is not a trade that I took, but this is just going back to December. So if you look here, imagine if you had entered around 16,734 in Bitcoin, and your stop loss was at 15,420, so just below the recent local low. And remember, I'm placing my stop loss based on structure. I didn't actually take this trade, but just pretend this trade was happening. Imagine it was a swing trade. And so as you can appreciate, the stop loss is quite wide. As the stop loss becomes wide, naturally the position size is going to be a lot lower. And so look, this is an actual entry calculator that I use, and of course I've put a link below to this calculator. And so as you can appreciate, so I picked a 100k account here because it's an easy number to work with. The entry price is 16,734. The stop loss was 15,420. So just going back to this, you can see 15,420, and the risk was 1% here. And this calculator shows a position size, so $12,735. And this does not account for leverage. So this is assuming that using 1x leverage. So naturally, if you use 10x leverage, then the position size will be 1,273. And that will be the amount of margin you'd put up. And once you put up that margin, you use leverage to meet the position size. And remember, leverage is just a tool. Leverage can be used to amplify your gains or also make you lose your account exponentially. And it has to be used sensibly and respected. And so as you can appreciate, the position size here of this trade is 0.76 Bitcoin, because naturally the stop loss was very wide. Now, this was an actual trade that I actually took. And this entry was on the same entry, 16,734. And I was quite vocal about this, especially before Christmas as well. We were in a huge period of contraction, but based on various metrics like structure. We were in an upward sloping channel, higher highs in the 4 hour, just volume profile. So many things. I entered this trade, and my stop loss was 16,570. Why did I place my stop loss there? Because this was a recent local low in the 4 hour, and so I put my stop loss around this purple line here, as you can see, because I know if I get stopped out, then structure would be broken, and ultimately this low would be taken out, would most likely go downwards again. And so that is why. And so this stop loss is a lot more tight. And so this was the trade in the calculator. So pretend it's a 100k account because it's an easy number to work with. This was my entry, 16,734. My stop loss was 16,570. So as you can appreciate, it was quite a tight stop loss, relatively speaking. And so my risk again was 1%. So this was my position size, so around 102k. And this is excluding leverage. So naturally, if you use, for example, 5x leverage, then you would actually have to put 20k of your own margin, and the 5x leverage would help to compensate for that. And as you can appreciate here, the position size is 6.1k roughly. Sorry, 6.1 Bitcoin, as you can see here. So as you can appreciate how just the actual width of the stop loss changes, that can greatly affect the size of that you actually have for the trade. Of course, the wider the stop loss, the less likely you're going to get stopped out. But it also means that you have to actually make more, and you expect more market movement for you to actually achieve your minimum risk-reward ratio trade. And so that's just something to consider as well. All these things have to be considered. There's no right or wrong. For example, you might vary depending on a swing trade or a scalp. And this is to highlight that how losses are often more painful than gains, right? And losses often negatively affect our psychology as well. Because, for example, imagine if you have a 70% win rate. That doesn't mean you're going to win the first 7 trades and then lose the last 3. You could, for example, lose the first 3 trades and then you might win the last 7 trades. And so the question is, are you able to maintain the same level of psychology and risk management despite losses and really see that the trades are just a statistic, and you would hope that your edge and your risk management really catches up over the long run across a huge sample of trades. And so this is to highlight that how just if you, for example, lose 5% of your account, for you to actually get back to your starting balance, you wouldn't have to gain 5%, you'd actually have to gain 5.2%. And similarly, for example, if you lost 7% of your account, then you would actually have to gain 7.5% to actually go back to the start value. And similarly, if you lost 10% of your account, then you would actually have to gain 11.1% to actually go back to the starting value. And this is just to appreciate that how, as you lose more money, naturally you need to gain a high percentage to actually go back to the start balance of the account. And I have certain golden rules now I want to share. And to really take your trading to a really higher level. And for example, I have a rule now, 3 consecutive losses in a day, just stop trading. So for example, if I risk 1% of my account, then if I had 3 losses in a day, I'd just stop trading. Because you need to realize that our psychology is just so vulnerable sometimes. We're only human. If we have enough losses, then sometimes it can really impact our psychology. We can do revenge trading. And so we need to have some kind of automated system, some kind of internal stop loss that prevents us from trading further. And so this is to appreciate how fear and greatly rule us as humans. Personally, it's quite rare for me to have this because I wouldn't trade anymore that many times a day. At the most, I usually trade maybe once or twice. It was the swing trading style. But what's more interesting is that I've set 3 consecutive losses. But you might decide, well, if you're risking 0.5% a day, you can say, well, if I lose more than 1.5% of my account in a day, I'm going to stop trading. What's actually perhaps more useful is looking at the percentage you're losing. So, for example, 3 consecutive losses might be 3% for one person who's risking 1% of their account. But if someone is risking 0.5%, then you can say, well, if I lose more than 1.5% of my account in a day, or if someone is risking 1.5% of their account in a trade, they can say, well, if I lose more than 4.5% of my account in a day, I'm going to stop trading. So you can just play around with this, but the main thing is you're consistent. Next thing, avoid going below 5% equity in a day. Obviously, it's very unlikely if you're not going to make that many trades, but this is just at the most, right? And so I think a good rule as well, make sure that you never go below 5% equity in a day in your account. I think this is it's a very good rule if you really plan to take this to a very professional level. And so this is something interesting as well. So this is at the most, okay? But personally, I aim to not lose more than 3% of my account in a day. So next rule, avoid going 10% equity value ever in your account. So for example, say to yourself, look, if I ever go 10% equity value in my account gets lost. I think this is a great rule, and I just think it makes sure that you avoid pointless trades, and it means that you're looking at this as a very business point of view, because at the end of the day, we're traders. We're not here just to make random useless trades, right? We have to be selective, and we need to have some kind of mechanism like this to really appreciate that this is a business. If we lose a certain amount of money, we have to pretend as if the account gets lost, and this really motivates us to constantly learn and take only high probability setups. And I made this table as well. This is quite a recent thing I've made. And this is a certain change because initially I was saying, 1% of your account per trade. But I think it greatly depends as well, depending on your portfolio size. I appreciate that if your account size is 1K, of course it's harder money, right? But you might feel that, well, I can be a bit more aggressive because it's not the end of the world if I lose it. So you might say, well, if I'm conservative, if I'm not as confident in trade, I might risk 0.5%. But on average, I would risk at the most 1 to 2%. If I'm highly confident, if I think this is a once in a lifetime, this is a trade that's come up and I might take it because just on this one chance, then you might risk 2 to 3% in a small account. You still have enough 50 attempts, right? If you risk 2% for your edge to catch up. And of course, as you grow an account, you have more to lose. And of course, losses can be exponential as well, right? So if you're conservative, you might risk 0.25%, right? If you decide, okay, well, I'm a bit more confident, but I'm not overconfident in this trade, and I think it's just standard trade I take, then you might risk 0.5%. If you're slightly more confident, you might go for 1% or 1.5%. And so this is just at the most, right? At the most, okay? But 99% of the time, you want to be taking trades in this medium category, I would say. And of course, you can vary. If it's a 10K to 100K account, you can vary it, right? But what I would say is that if you have a string of losses, for example, 5 losses in a row, then perhaps something just might be off. You might just have woken up on the wrong side of bed. So perhaps you might decide, well, okay, I might take half of my account balance. So for example, say you have a 10K account and you make many losses, you might take 5K out and move it away. So you only have 5K left that you actually visually see and risk 1% of that. Because that will really ensure and really build up your confidence again. So if you have a string of losses, just perhaps risk half the amount you're usually risking. As you grow more, you have a lot more to lose. You need to be a lot more conservative, I'd say, because you're going away from this exponential phase to this more conservative phase. Okay, so conservatively, you might risk 0.25%. Okay, for example, if you see that, well, if you're in this 500k category plus, you might say, well, I like this trade, there's a valid setup, but I'm not as confident. Okay, I'm going to risk this much. Most trades, I'll risk 0.5%, because that means I have 200 attempts before I blow up my account. Of course, to go to this side, you would definitely have to be a high-level trader to get from here, from this initial stage, right? But you have a lot to lose as well, and so you appreciate that as you make more, the losses are also exponential as well. You're highly confident you might risk 1%, 1.5%. And so you just have to really see. But I think the general gist of what I'm trying to say here is that have a set amount that you're going to risk for most trades, 80 to 90% of the time. So mostly, for example, my situation, 1%. If I'm less confident, perhaps maybe 0.25%. But most of the time, I'll be risking 0.5 to 1% of my account. If, for example, I see a very good opportunity and it's a high probability setup, that's like once a blue moon. Like, for example, I saw Bitcoin run 16.8k before Christmas. Then I risk 1.5%. And so you just have to, you can now try and really vary your confidence in the trade and really try and adjust your trade size based on that as well. So naturally, confidence and portfolio size matter as well. So going back to this question, who's really taking more risk? Bob, who risks a total of $50 per trade with 2x leverage out of his $500 account? Or Sam, who risks a total of $1,000 per trade after his 10x leverage out of his 100k account? Okay, Temp's got the answer right. The answer is Bob is risking more. Because, okay, now Jeff is saying it as well. Yeah, great guys. Yes, Bob is risking more. Because whilst Bob is risking a less amount in terms of nominal value compared to Sam, proportionately, Bob is actually risking 10% of his actual overall account. Sam, in this case, whilst he's risking a higher amount in terms of nominal value, and you might be lured into thinking that he's taking more risk because he's using 10x leverage, not the case, because he's risking 1% of his account. And you have to appreciate that leverage is all relative. You sometimes hear people say, oh, that person's a bad trader because they're using 10x leverage, or that person's a bad trader because they're using 20x leverage. You have to take that in context. If you look at the FTX saga, for example, a lot of good traders would have lost hundreds of thousands because they kept all their money on one exchange. So sometimes leverage is a mechanism in which a trader might use higher leverage, so they don't have to put, for example, imagine if a trader has 100k. They might not want to put all their money into one account. Because what if the exchange goes bust, right? So they might decide, well, I might put 5k, or I might put 10k, or I might put 20k and put the rest in my bank because I wouldn't feel comfortable. I'd rather use leverage to actually meet the position size. And they may decide to actually transfer money to the trading account on an ad hoc basis whenever they feel they need to. And so you have to appreciate how everything has to be taken in context. Leverage has to be taken into context with various other factors, right? And so you cannot rely on leverage alone. You have to take into account risk reward, leverage, percentage risk of account, right? So all these things work together. But this is all I have to talk, guys, about risk management. And of course, check out my YouTube channel, which I set up quite recently. This is where I post my passion for crypto and trading and really sharing tips and tricks to really fast track your trading process. Well, thanks a lot, guys, for watching. I'll catch you in a bit.